So welcome to this webinar, which is the first webinar we're organizing from the EDHEC Business School and Scientific Beta Research Chair. Let me just briefly tell you about this research chair. So EDHEC Business School and Scientific Beta launched this research chair 2 years ago. So the objective of the chair is to support research on factor and ESG investing. And the idea behind this is clearly to, provide evidence-based answers to investment problems. And so there's a growing awareness now in society that, it's important to, as people say, listen to the science. So this, it has become important and has been mentioned when it comes to things like climate change, dealing with the global pandemic, etc. And so we think that also when it comes to investment decisions, it's important to base decisions on the evidence and on rigorous foundations. And so with this research chair, we're just trying to make a small contribution to that, to move the industry in that direction of learning more about the evidence and acting as a function of the evidence. So today we're going to hear about a very specific research question. So let me just give you the background on that research question. So the research chair develops research on a number of topics connected to ESG and factor investing. And this research is conducted through EDHEC faculty members and also Scientific Beta researchers. So there are several research papers on different topics, transaction costs, ESG investing, pricing of ESG related factors, etc. But beyond this research by EDHEC faculty and Scientific Beta researchers themselves, the chair also seeks contributions from external researchers. And so in this context, we launched a call for proposals. So in September last year, we launched a call for proposals on an important question in the industry, which is how does actually intangible capital affect asset pricing factors? So this, intangible capital might not be included in standard measures of firm characteristics that people use when they construct factor models or factor investing products. But, in principle, there may be reasons to actually account for this. So how should this be done? So this was the question. And the research grant was then awarded about a year ago to Hussein Gulen, Dongmei Li, Ryan Peters, and Murat Zaknini. And so the authors, have worked on this topic, have come up with a working paper. And so they're here to present their research today. So I'm looking forward to the presentation, and I leave the floor to Ryan Peters for the research presentation.
All right, let me get this up. Hopefully visible to everybody. It says it is. So thank you, Felix, and thank you for the research chair for allowing us to present our work today. This is Intangible Capital and Factor Models, and I'm Ryan Peters at Tulane University here in New Orleans. This is joint work with Hussein Gulen at Purdue, Dongmei Li at the University of South Carolina, and Murat Zaknini currently at Michigan State. Now whether I can move the slides, there we go. So this is going to be an empirical asset pricing paper where we're going to revisit the traditional measures that are commonly used, at least in the empirical finance literature, and are based on firm characteristics. Firm characteristics are going to be constructed from accounting statements, which by the accounting rules are going to ignore what we're going to think of as really important types of assets owned by firms, and those are off-balance sheet intangible assets. We think about the product of research, of product development, human capital investment, brands. None of these things are going to show up on firm balance sheets, and that's going to leave a pretty large hole in building characteristics for building investment portfolios and investment factors to explain returns. So we're going to revisit three of the sort of dominant asset pricing factor models in the academic literature. That's the Fama-French 3-factor model, the Fama-French 5-factor model, and the Hongzhu and Zhang 4factor model. We're going to explicitly address the presence of a different type of capital stock in the sort of theoretical foundations of these empirical asset pricing models. We're going to ask how the inclusion of a new type of capital affects the resulting factors. We're going to find that including off-balance sheet intangible assets significantly improves the performance of these factor models. And we're going to identify a new off-balance sheet measure for HML, which is the value factor that's going to be particularly salient in its performance improvement. So to give you an idea of the size of intangible assets as we're thinking about them, these are the empirical intangible capital intensities. And this is the result of another paper of mine with Mike Ewens and Sean Wang, where we explicitly try to measure the intangible capital stock in firms. That's its own paper, and I'm not going to talk about the estimation of that paper today, but we take seriously investigating the structural parameters of the intangible capital accumulation process. So how to translate firm expenses from the income statement into proxies for the value of the off-balance sheet intangible capital stock. So again, things like the value of patents, human capital, brand, and things like that. The estimates we come up with in that paper suggest that that intangible capital is a significant portion of firm assets and rising over time. So this shows in around 2000, the average firm had approximately the same size intangible capital stock as they did physical capital. And today, or I guess these numbers go up to about 2016, we're up above 60%. So the intangible capital stock for the average firm traded in US equity markets is actually larger than their physical capital stock. This is maybe not, surprising if you think about the companies that we think of as dominating the market today, Amazon, Apple, Google, who own a lot of intangible assets. So this is our estimation in that paper goes industry level at sort of broad industry classifications, consumer, manufacturing, high tech, healthcare. Obviously, the proportion of intangible assets in these firms differs across industries in what I think are sensible ways. The 3-factor models that we're going to be investigating in this paper are the Fama-French 3 and 5-factor models and the HXZ model, the Hongzhu and Zhang Q-factor models. Just briefly to summarize these, the Fama-French 3-factor model, which hopefully everyone's at least somewhat familiar with, says you can explain a significant portion of the cross-section of stock returns with 3 factors. The first is the market factor, just regressing on aggregate market performance. And then the other 2 factors are the small minus big portfolio, or the size premium, and then the HML portfolio, which is the value premium. Fama-French 2015 introduced 2 more factors and built a Fama-French 5-factor model, so that augments the original Fama-French 3-factor model with 2 new portfolios, one for investment, that's CMA, and one for operating profitability, that's RMW. The HXZ model has only 4 factors. They actually drop the value premium. So they have the market factor, the size factor, an investment factor, and the return on equity. So there's some not trivial differences between these factor models. We're going to revisit each of them in turn, sort of theoretically, and then see how intangible assets should be thought of in the context of these asset pricing models. We're then going to augment these asset pricing models with some new factors that do directly account for intangible assets. So the first model, the Fama-French 3-factor model, probably the greatest workhorse of empirical asset pricing, originally proposed book to market as a proxy for distressed risk, that firms with high book assets relative to their market price are probably facing some sort of distress, and that investing in these distressed firms can give you positive returns over time relative to investing in growth firms. So as a proxy for distress risk, we can think about intangible assets in that way. Well, we think intangibles differ sort of significantly from physical assets and their distress related characteristics. For example, pledgeability. You're not necessarily able to pledge your human capital stock in terms of recovery rates. Things like organizational capital, distribution networks may not be recoverable in bankruptcy. And there's a paper by Franzen, Rogers, and Simon that discusses full expensing of R&D, leading to misclassification of distressed firms, which is sort of what we're thinking about here. If there are firms, say, Amazon has lots of intangible assets and relatively less physical assets, maybe Google's a better example. Amazon does a lot of things. That you may accidentally misclassify a firm like Google as being distressed, rather than having just a ton of off-balance sheet intangible assets. The Fama-French 5-factor model comes from a more formal framework. So they start by expressing the value of the firm as the present discounted value of the future dividend flows. We can say dividends are revenues minus costs, or pi minus I for investment. If we assume this firm is already in steady state, i.e. that they're not moving around, they've already reached their optimal capital shares and things like that, we can rearrange the Gordon growth model to put the returns on the left-hand side as a function of firm characteristics. We find that returns are a function of profitability, of investment, and by K divided by P, which is the capital stock divided by the price of the firm, or the book to market ratio. We're going to then take that foundational framework for the Fama-French 5-factor model and ask, well, what if the firm has two different assets? KB, which is the on balance sheet, call them physical assets, and the KO, which is the off balance sheet, call them intangible assets. We're gonna do some of the math and find a similar but different relationship between returns and firm characteristics. Now, notably, if the characteristics of the on-balance sheet and the off-balance sheet assets are the same, or if IB equals IO in this notation, then we can aggregate the types of capital into a single measure, and that would lead you to build one adjusted book to market ratio, as is done in Park and a number of other papers. But if they are distinct, and if firms differ in their use of these two types of assets, then we need to separate them. So the measurement paper where we try to measure the size of these capital shocks shows that the intangible intensity across firms varies, that firms differ in their use of off-balance sheet intangible assets. You can also think about that from the figure I showed you, suggesting that you may want to treat these types of assets differently empirically when you try to go and build factor models. The third factor model we're thinking about in this paper is the HXZ Q factors model. That comes from a very different place in terms of theoretically motivating the factors that are used. So rather than a Gordon growth discounted dividend model, this is going to come from an optimal investment problem that the firm faces. So in their 2015 paper, they write down a 2-period optimal investment model. Sort of ignore this. This just says, what investment will the firm choose to maximize its value in year 0, given that it exists until year 1, and faces capital adjustment costs or costs of moving around its capital stock and faces some accounting identities. So you can solve this model through standard first order condition, and you find that the expected return is a function of the firm's profitability, A, its cost of adjusting its capital stock, and I, its investment. And that's where the three of the four factors come from. And then since everything here is sort of size invariant, they tack on a size factor, and that gets you the fourth factor. So we're going to start with the same place. We're going to add a second type of intangible capital, a second type of capital, which we're going to characterize as intangible capital. And we're going to derive a relationship between expected returns and firm characteristics. And again, we're going to be left with if this new type of capital is the same in some sense as the old type of capital, then we're going to be able to aggregate things. And here, the same means the same cost of adjustment and the same investment rate. I've got another paper with Luke Taylor that I did in grad school at Wharton that has, I would say, very strong evidence that intangible capital differs from tangible assets in its cost of adjusting. And you can just think of that intuitively. It's a lot easier to buy more, whatever, cars or machines than it is to build out your intangible capital stock, to build new products or invest in new patents. And so we're going to come from a place where we think these characteristics do differ, and that it's worth splitting out these measures of intangibles into the construction of new factors, and then we're going to augment the sort of workhorse asset pricing models in the literature and ask what these new factors or adjusted factors do. We're going to use standard CRISP and CompuStat data in our construction of the factors, hewing as closely as possible to the original papers in their factor construction, with the only difference being that we're going to augment with intangible assets. And our measure of intangible assets is going to be from the measurement paper by Niemann and Zhang. So when we think about intangible investments, what spending goes into intangible assets, that's going to be all of research and development costs. So any money the firm's spending and reporting as research and development, and then a fraction of selling, general, and administrative expenses. So SG&A includes a lot of things, some of which are properly thought of as overhead, but other things, say employee trainings or spending on advertising to build brand capital, are going to be better thought of, I think, as investments in the intangible capital stock. And we're going to explicitly, in that other paper, measure what fraction of SG&A spending is properly thought of as an investment in organizational capital. And we're going to do that by industries. We're going to take the estimates from that paper and apply them here. So we'll walk sort of briefly through the construction of the factors in these asset pricing models. So the value factor, the traditional value factor, HML, is constructed by double sorting on book to market and size across the CRISP universe of firms. We're going to build the same HML factor, and we're additionally going to build two others, only one of which I'm going to talk about today, altered value factors. So the one we're going to focus on here is the HML OBS, which is going to be constructed by double sorting on size, and the off-balance sheet book to market. So that's the measure of off-balance sheet intangible assets divided by the value of equity. In the paper, we also think about a total HML. You can aggregate the two capital stocks, again, if you think that the characteristics of these assets are similar enough. And that would be the HML total factor constructed on a double sort on size, and the book to market total, where you just aggregate the capital stocks. One piece of evidence that these types of assets do act differently is that actually once you construct our two HML factors, the correlation between those two factors is honestly shockingly low. It's 0.01. So there's almost no correlation between the HML factor constructed traditionally and then our new HML OBS, which I think is super interesting. I'll apologize in advance. I have a 2-year-old and he is upset about breakfast. So just, briefly to go over the summary statistics of these factor series, starting with the market, mean returns of 0.61, that's 61 basis points per month. All of the numbers I'm going to show you are going to be monthly numbers with a standard deviation of 4.37%, a monthly standard deviation of the stock market, and a Sharpe ratio of 0.14. That's a monthly Sharpe ratio. So when I show you monthly Sharpe ratios, and there will be a lot of Sharpe ratios in this table, if you're used to thinking about, for example, annualized Sharpe ratios, just take that number, multiply it by 3.5. Here, that gets you what? I don't know, 0.5. There's the SMB factor, the small firm premium, which is smaller in mean returns, and the traditional measure of HML, which earns a mean return of 23 basis points per month. I'm going to then show you the 2 new HML factors that we have. Obviously, the one that we're going to focus on here is the HML OBS, the value factor constructed with off-balance sheet intangible assets. That earns a mean return over our full data sample of 46 basis points per month. So that's double the size of the traditional HML factor, which is kind of nice, and actually has a smaller standard deviation, which leads it to have even greater than double Sharpe ratio than the traditional HML measure. You can also think about HML total, which we do in the paper. Thinking about the performance of these factors, not only over the full sample, but in sort of more recent times, which we're going to count as the last 20 or so years versus the first 20 years of our sample, gives some really interesting time series dynamics. So the advantage of the OBS measure of HML over the traditional measure is dramatically larger in the second half of the sample. So in the last 20 years, the traditional value factor has produced returns around 10% or 10 basis points per month. The OBS HML has delivered average returns around 52 basis points per month. Again, multiplying by about 3.5 to get yourself to an annualized Sharpe ratio from the 0.22 that we see here, and you find an annualized Sharpe ratio of around 0.8, which is not bad. Thinking about what these returns look like in sort of finer windows, there's a picture of 5-year rolling average returns. And so there's been a lot of digital ink spilt in the last couple of years about the falling performance of the value investing sort of strategy. And here you can see that by the solid line, which represents the return of the value premium portfolio over time, falling below zero and mostly staying below zero since about the mid to late 2000s. Whereas our new HML OBS factor does not fall below zero. Though interestingly, you do sort of see this sort of this downward time trend in all of the value factors we've constructed. But it's nice that HML OBS has decided to stay at least positive over the last couple of decades. We actually are getting a data update hopefully later today that lets us do these numbers through about mid-2020, which will be really nice to see how the performance has changed over this year. So we've got other factors. There's the investment factor, which is constructed somewhat differently in the Fama-French and HXE frameworks. We're going to use a slightly adjusted version relative to their papers, where we focus on the percent change in physical assets on the balance sheet rather than asset growth, which uses total assets on the balance sheet, which includes a lot of non-physical things. But those are details that I think we can properly relegate to the paper. And again, we're going to compare the traditional versus our OBS measures. So here, CMA is again constructed on annual changes in either PP&E, property, plant, and equipment on the firm balance sheet, or OBS. That's our measure of the intangible capital stock. Investment is going to be the INVs from the HXZ model. That's going to be estimated on quarterly data, but is largely similarly constructed. We're going to find the intangible version of these factors is essentially comparable to the physical counterparts. The correlations here are actually pretty high too, which is interesting. Though, again, we see a little bit outperformance of the intangible capital versions in the last 20 years relative to the beginning of the sample, though not nearly as dramatic as in the value premium setting. And then finally, we've got factors built based on profitability. We're not going to be able to split cash flows. So in the value setting and in the investment setting, we're going to be able to say this is physical, this is intangible. Obviously, when looking at cash flows, whether in operating profitability or net income, we're not going to be able to distinguish cash flows driven by physical and intangible assets, right? In the firm, those are going to work together to produce revenue. So we're going to have an adjusted, or we're going to call it a total version of these factors. There is a typo on this slide. That's my mistake. Either way, we're going to adjust the either operating profitability or return on or the net income to properly, I would say, consider intangible investments and spending on intangible assets investments rather than expenses. And we're going to make the appropriate adjustments, which is not the adjustment on that slide, unfortunately. Here, we're going to find similar full-time series performance. The correlations between the new factors and the old factors are a little bit lower. And again, we have a little bit more outperformance in the later part of the sample, especially with the Fama-French 5-factor version of the profitability measure. And yeah, these things are largely comparable, though we're going to get a little more interesting things. So we're going to focus in the paper on the HML OBS because it does exhibit the largest difference. And I think it's sort of the most interesting result, but we're going to take seriously everything. Given my time constraints, I'm going to move a little faster. So our first exercise here is going to be to sort the firms into their characteristic decile portfolios. So when we sort things into factors, you sort of aggregate a lot and you lose some of the more fine-grained view of what's happening in the actual assets. So rather than sorting into, when you build factors, you sort into three portfolios, usually comparing the top 30% to the bottom 30%. So here we're going to zoom in and show how each of these deciles performs on average. So starting in the first line, we've got the traditional measure, firms sorted on the traditional measure of book to market, which shows a not trivial difference in performance over time. These are average monthly average stock returns of these portfolios, and a high minus low average return of 36 basis points per month. That's taking the high portfolio, the 10th decile, and subtracting or shorting the first decile. But we can compare that to the high minus low from the decile sorts of the off-balance sheet book to market sorted firms, which shows dramatically larger 61 basis points per month performance. Again, sort of in the interest of time, I'm going to skip the investment ones. It looks a little similar. The off-balance sheet measure goes down a little bit. When we look at firms sorted on net income, that's the ROE, we see again a sort of not trivial increase in the performance. And so here, I think it's nice to see this happen, that in fact, treating the cash flows properly, so treating the cash flows, the spending from R&D and that fraction of SG&A as investment rather than expenses actually gives us a better view into the performance of the company. So larger here, decile high-low returns. We're then going to ask, if we try to explain the traditional HML factor using the other here, the Fama-French 5 factors, are we left with HML providing some benefit in terms of alpha that is not explained by the other factors? So here, starting with column 1, we're going to regress the HML factor on the market, the size premium, and then our new measure of HML OBS. And we're going to find that there is some value left, some alpha left after accounting for these factors. When we additionally augment with the investment and profitability factors from the Fama-French 5 factor model, that outperformance is going to become, well, in column 2, negative and not statistically significant. When trying to explain it with all of the intangible capital augmented 5 factor, now 7 factor model factors, it's going to come back a little bit to 16 basis points per month, almost statistically significant. So we're not saying you should ignore the old HML. It does provide information and investment performance, but rather that you should be augmenting with our new factor. This is the same factor spanning test of the new HML OBS, which is not spanned by the other for the other factors in the Fama-French 3, 4, 5 or augmented 5 factor models, and consistently shows a different source of investment performance over the sample. So given a factor model, how should one invest? So this is a picture that asks the question, if you were in, for example, the year 2000, you looked ex post at these factor returns over the last 20 years and tried to build yourself a portfolio by putting weights into those factors that maximized your ex post Sharpe ratio, what would that portfolio look like? So we're going to ask, this is in the context of the augmented Fama-French 3 factor model. In each year, what does your Sharpe ratio maximizing portfolio look like over time? And this, I think, tells the story pretty well that I'm about to show in tables, that the new HML OBS factor is coming to dominate the optimal portfolio here. So these factor shares are going to add up to 1. And so gains by one factor are going to be offset by losses in another factor. And this is going to show that while in 2000 you would have invested, say, 50% of your portfolio in the HML OBS factor, around 30% in both the market and the traditional HML factor, and then here, sort of minus 10% in the size premium, so going overweight large firms rather than small firms. That would have given you the largest ex post Sharpe ratio. By 2017, 2018, you are now investing over 100% of your investable assets in HML OBS. A almost trivial amount in the traditional HML measure, more negative amount in the size premiums, so going more overweight large firms, and only 20-ish% in the actual market. So this HML OBS factor really wants to take over an optimal portfolio. We're going to start with the logic of these optimal portfolios. We're going to be doing statistical tests based on a paper by Deciles and co-authors. I'm not going to go into the mathematical details here. Let me just start by giving you an example. So we're going to take 2 factor models. We're going to calculate these optimal portfolio ex post Sharpe ratios. And then the Deciles test is going to allow us to statistically determine whether one of these factor models is better than the other, taking into account the normal statistical stuff, the correlation structure across the factors, the variance of the estimates, and also the number of factors that come to bear in building this optimal portfolio. So on the left here, model A is the intangible capital augmented Fama-French 3-factor model. And we can see over the full sample, in terms of the portfolio weights, the ex post Sharpe ratio maximizing portfolio wants to put a 23% weight into the market, a minus 10% weight into the SMB factor, a 24% weight into the traditional HML factor, and a 64% weight into the OBS HML factor. That's going to give you a monthly Sharpe ratio of 0.27. We can compare that statistically to here model B is the traditional HML model, the traditional Fama-French 3-factor model, which puts a 36% weight on the market, a 19% weight on the size premium, and a 45% weight on the value premium to give a Sharpe ratio of 0.19. And then the final column here is going to be the t-statistic from the test of whether model A is better than model B. And here we get a t-statistic of 1.88, which is, statistically significant at the 10% level. So not super strong statistical power here, but I think the Sharpe ratios tell the story. We can take this and then split it into the two subperiods, which I think show results very consistent with the picture I just showed you. In the early period, you get not trivial loadings on the OBS measure of HML, but you don't get much outperformance in terms of ex post maximum Sharpe ratios. The augmented model gives 0.32 Sharpe ratio, and the unaugmented model gives a 0.3 Sharpe ratio, and that difference is very not statistically significant. In the second period, however, we see, consistent with that picture, HML OBS absolutely taking over the optimal portfolio. And while given our reduced sample size here, we don't have the statistical power to distinguish these, I think the story here is told in the weights and the Sharpe ratios. So by building the optimal, the ex post optimal portfolio, we earn a Sharpe ratio of 0.27 relative to in the unaugmented model, where we get an optimal ex post Sharpe ratio of 0.14. So almost twice as big by including intangible asset factors. And again, sort of not super statistically significant, but a dramatic result. So we're going to do this. We have a lot of these in the paper. So if you feel like digging into the paper and looking at optimal ex post Sharpe ratio portfolios, I certainly invite you to. I'm going to show you a few and tell some nice stories. So first, this is the intangible capital augmented Fama-French 5-factor model versus the unaugmented, the traditional version from Fama-French 2015. Here we see non-trivial loadings on the HML OBS and sort of smaller, but still non-zero loadings on the traditional measure of HML. In the augmented model, in the unaugmented model, earns a Sharpe ratio of 28 basis points per 0.28 monthly Sharpe ratio. The augmented model gets a 0.38 monthly Sharpe ratio, and this difference is quite statistically significant. And here the improvement is basically entirely in the second half of the sample. I'm not going to show you the time breakdown, but I think they are like literally the same in the first half of the sample, and then the intangible capital augmented version really takes off and shows a dramatic outperformance in the last 20 years. Here we're going to compare the HXZ 4-factor model with the intangible capital adjustments made to the traditional measure of HXZ, and here we don't see intangible capital making a huge difference in the HXZ 4-factor model. However, if we additionally include the traditional and OBS measures of HML to the 4-factor model, we do see statistically significant outperformance of this augmented model. Now, there's sort of the point of the HXZ model was to say you don't need value if you've got the market, the size premium, investment, and profitability measured the way they do. And we're basically saying you still do if you think about intangible assets in the context of the value portfolios. So it's sort of in the academic finance literature, it's well known that the HXZ model outperforms the Fama-French 5-factor model in terms of asset pricing tests. We're showing that that's no longer true once we incorporate intangibles into both. In fact, the intangible capital augmented Fama-French 5-factor model has slight but not statistically significant outperformance relative to the HXZ model. And though in fact does outperform significantly in the second half of the sample in the last 20 years. So that's the wrap up. I think I tried to stay vaguely in time. The story is that intangibles play an increasingly important role in the economy in the US and likely broader, though our data is all US data. The majority of intangible assets are not reported on the balance sheet. So you're gonna have to, if you want to include these things, take seriously the measurement of intangible assets. And that we can adjust characteristic factors in a number of ways. One is to aggregate things, which our story is that you can't really do unless you want to make some sort of unreasonable assumptions about what these assets look like in the real world, or you can disaggregate them as we have done here, and we show that provides a big benefit to your investment factors. We show that including intangible assets is particularly important for the value factor, though has some non-trivial effects on some of the other factors, and that the traditional measure of value, which has sort of turned negative in the last few years, it's maybe recoverable if we think about intangible assets. So we make a couple of changes in this paper relative to the originally published papers. And our summary is that the Fama-French 3 and 5-factor models are significantly better than they started once we've made all our changes. The HXZ model is a little bit worse. We no longer find that the HXZ model is outperforming the Fama-French 5-factor model. And in fact, in our paper, the best model is sort of an HXZ with the intangible value and traditional value measures still included. So if you want to call that the GLPZ 5-factor model, I wouldn't stop you. And that is it. That is my paper. Apologies for anybody who didn't want to listen to a very academic finance talk today. Thanks.
Thank you very much, Ryan, for the presentation. So I'd just like to make a few comments to kind of conclude on this topic, just provide a bit of perspective on my thoughts on the paper, and then we will open up for questions afterwards. So I'll just try to share a few slides with some conclusions. So I really enjoyed first reading the paper and then listening to the presentation, and there's really three things that I like a lot about this paper. So the first thing is that I think there are substantial new insights that I think are very interesting about what kind of factor models should we be using, and also from that how should we think about factor investing. Secondly, I think what is interesting also is that just reading the paper, I think there's lots of questions that come up. So some of them probably beyond the scope of this paper. So I just want to also share some of the thoughts that that come from the analysis in the paper. And finally, I also think that the paper has quite a nice perspective to factor models. And so let me just go through these three different points. So in terms of insights, so clearly I think there are important new insights from the paper. So we should think carefully about what is an appropriate multi-factor model. And what I like in particular is that these insights are built on strong theoretical foundations. So clearly, instead of coming up with the loose motivation of these augmented factor models, the authors really go back to how the original factor models were motivated. So this dividend discount model that was used to motivate the Fama-French 5-factor model, and these optimal investment model that was used to motivate the Ho-Shui and Zhang 4-factor models. And they basically go back to the same starting point and say, well, what kind of conclusion do we get if we additionally account for a different type of capital, which is intangible capital. So I think the foundations are very clear and strong, and also from the empirical tests, I think the conclusions are quite clear. So we see that including in intangible capital, clearly improves the explanatory power of these models, or in a kind of investment context, you get an improvement in the Sharpe ratio by augmenting the models with intangible capital. And then very interesting, the value factor is no longer redundant when including these intangibles. Now, beyond the actual content of the paper, just some food for thought. I think there's a few thoughts that I had when reading the paper. I think probably most of them are beyond the scope of the paper, but just first point is the results clearly suggest an important role for in intangibles in the value factor. So this off-balance sheet value factor plays a large role. For investment and profitability, intangibles matter less. So the question is, why is that the case? Is that just a simple explanation that kind of if you rank stocks by investment? Sorry, just to interrupt. I just pause very briefly. So the question is then, is that just a simple explanation that measuring intangibles also in investment doesn't really change that measure much, or is there some deeper explanation that some of the pricing of intangibles in that context is less present? Another question I had is on decomposing factors. So again, this is probably beyond the scope of the paper, but the paper looks at different types of the different types of capital, and kind of decomposes capital into two types in this case. Now, there's other decompositions that have been proposed. So in particular for the value factor, so a paper by Ball, for example, that decomposes the book value into retained earnings on the one hand and contributed capital on the other hand. So that's completely different type of decomposition conceptually. That seems to be a completely separate issue. But still, I think the question is there any relationship between these different decompositions, and kind of what are the trade-offs really that we're faced with when decomposing factors in that way? Another point that I found interesting is that we could learn something about some external findings, so other findings that are out there on constructing factors. So there's some findings that suggest factors would be better constructed within regions when you look at an international context. So rather than global factors, we should look at regional factors. And also there's benefits to constructing these factors within sectors. So I think a question I would have is, can we actually explain some of these findings using the framework of the paper? So either kind of directly. So we've seen that there's important differences in terms of intangible capital across the different industries. So that may mean that you can actually account for some of this by constructing factors within each sector, and also perhaps more indirectly. So these let's say that this separate factor that includes intangible capitals was motivated by differences in the adjustment costs to intangibles as opposed to other types of capital. So similarly, there could be differences in adjustment costs across industries. So perhaps it would be possible to also use this theoretical framework to motivate why we actually would like to construct factors either within regions or within sectors. So those just some points that I would say are just food for further thought. Now, to kind of conclude my discussion, I want to point out that I find the angle that the paper takes very promising. So if you look at research on these factor models. I think a lot of that research probably tries to go quite far in coming up with kind of completely new approaches and questioning a lot of the existing models. Now, on the other hand, we know that empirically these existing models tend to work relatively well. So a lot of research tries to, for example, find new factors that kind of completely overturn these models. So papers trying to come up with a single factor that kind of subsumes all these other factors. So that's obviously nice, but probably a very ambitious goal. Also, you have lots of research on new methods to kind of finding these factors and testing these factor models that may again lead to different conclusions. So I think this paper takes an interesting approach, which I would call more as trying to have a kind of evolution of these factor models. So I illustrated this here with different generations of the Porsche car. So this goes back to 1980 to roughly today. You can see it's basically the same car, but it's probably the last one is better than the one from the 80s. But it's better, but it's still the same car. And so we could say in the same way, the car down there could be the Fama-French 3-factor model, and then we move to the 4-factor model where you add momentum, the Fama-French Carhart, and then maybe we move to the Fama-French 5, and then to the Zhang 4. Then you have other models like the 6-factor model by Fama-French, the 5-factor model by Zhang, where they yet add some other factors, and maybe the factor model in this paper could be the latest version of that evolution. And what I really like about this is that the paper really shows that properly measuring these factors and kind of augmenting the existing models actually leads to good factor models, and these workhorse models actually work, and you can improve them. And I think that's a nice angle to research on factor models. So with that, I think we can open up for questions. I don't know, Ryan, if you want to somehow comment or reply on those remarks before we open for questions.
Can you go back slide? I did have a couple of thoughts, but then. Well, thank you for the comment. Laura, take it. I'm done.
Well, I was thinking about some of your comments, Felix, and sorry for jumping in, but I specifically wanted to address the first one that you had, which is why do the adjustments work more for book to market, but not as much for investment and profitability? And again, we don't do a lot in the paper to actually address that, but one of the thoughts that we've discussed is that you have to think about really what we are saying. What we are saying is that there is measurement error in how you measure all of these variables, right? And these measurement errors, the way that we are correcting for them, it is a lot easier to correct and be confident about how you address the stocks of capital as opposed to the changes. So basically, I know that a firm spent $1 billion in R&D. I don't know how much of that actually turned out into assets this specific year or exactly what the assets did. But if I look at what they spent over the last 10 years, I have a much clearer picture of exactly what they did, right? So because book to market looks at the stock and not the change, it's a lot more accurate, and we don't have as much of a measurement error. So that would be at least one thing that could explain some of these results. And also, I think, especially for profitability, I think we would make a lot. If you believe the model motivations, you would think that we would do a lot better if we were able to kind of segregate the profits that are coming from intangible assets, right? If I go to Google and I'm like, let me see how much of it is coming from your intangible assets, or actually probably, as Ryan said, Amazon, see how much of it is coming from their software and ideas and how much of it is coming from their warehouses. If I were able to separate these two, I'll probably get a much better prediction of returns. But because we don't, I think book to market is the correction is slightly better than what we get for the other characteristics. Ryan, I'll give you the floor back.
I think that was probably better than I could have said it. Yeah, in general, measuring stocks, the measure is built. My paper with Mike and Sean, where we actually measure the thing. We measure the stocks. That's the goal. Measuring the flows is a laudable goal that is not ours and is in general much harder to get a precise measure of the time series of the flows. So the goal of our paper was to measure how big is the stuff, and then we take sort of the outcome of that process, and we sort of back out the flows, but it's a lot harder to think about because we do get aggregated financial statements, and that's what we're working with.
Yeah, and Felix, another one of the questions that you had was about constructing the factors within regions or basically within subsets of assets. I think probably the most natural extension of what we are doing, and there are a couple of papers out there. I think Pontiff and co-authors, and I'm sorry that I'm forgetting all of the co-authors, had this paper that looks at basically the factors and these characteristics and how if you adjust them within industry, that you typically get better performance. And I think in the context of what we are doing and in the context of correcting these measurement errors, we are probably more confident that these corrections are happening better within industry. So it might give us, and that's an extension that we haven't done, but obviously something that can be done in future work.
Can I also jump in to add a few other observations? Thank you very much, Felix, for all these comments. I feel those are very good questions for us to think about. So in terms of the implication of the adjustment to investment factor and the profitability factor, I think part of the reason is we recently actually update our definition of the adjusted OP total. So actually after that adjustment, our current results presented in the slides, not in the previous paper, actually show a significant improvement compared to Fama-French profitability factor. In fact, in the second period, the Sharpe ratio of this adjusted OP total factor actually almost double the Sharpe ratio of the original Fama-French profitability factor. So basically our more updated results indicate a significant improvement in terms of profitability factor. In terms of investment factor, even though on average, the impact is not that big, but if you look at the time series change, we do see a significant shift in terms of relative importance of intangible investment relative to traditional capital investment. So if you look at the previous period, CapEx play a very important role. But if you look at the second period, we do show that intangible investment play a much more important role. So even though overall it doesn't impact the performance, but it does show relative importance of intangible over time. Yeah, and all the other questions are also very important. Thank you.
Okay, thank you very much for those explanations. So I think we can open up for questions from the audience. So we did get a few questions. So maybe I'll just start with the first one. So there's a question on kind of the role of earnings to price in the models, and the question is also how is the HML off balance sheet measure related to measures like price earnings? I guess more generally, what would be the role of earnings to price in these models, and perhaps also the impact that intangibles would have there.
So let me. I thought about that one. I was cheating and looking at the questions as Ryan was presenting, and I was thinking about the question, and I really like the question of thinking, how does HML OBS compare to some factor that would be built off of the price to earnings ratio? And I like that Felix mentioned it as earnings to price, because that's how I've been doodling on a piece of paper here. And I'm just thinking, if you look at earnings to price, you can actually just decompose it. It's earnings to assets, which is basically the profitability factor, times assets divided by price, which is the book to market ratio. So in a sense, earnings to price is, I think we have not looked at a direct comparison to a PE ratio, but I think what you can think of is that an earnings to price ratio is simply the interaction of profitability and book to market. And to the extent that that's all it is, and I know we are missing a little bit of nuance by not separating them, or by separating them actually, but I think you can think of the improvements that HML does, that we do to HML, and the improvements that we do to profitability, especially with the new results regarding operating profitability that Dong Mei was mentioning. And I think we have not looked at it directly, but I think if we adjust if we make the adjustment, you can see that both of them are improving, which will tell me that this is gonna perform a lot better than traditional PE ratios.
All right, thank you for that. So a question from Raman Upal, two questions actually. So first, why is the performance of the model that is based on OBS only present in the second half of the sample and not in the first half of the sample? And then I'll just follow up with the second part of the question, or the second question. So are the results that are reported out of sample or in sample? Do you comment on that?
I'll comment. I think so. It's probably easier to answer the second part, which is that the results are in sample, in the sense that we are just using these measures and we are building factors off of them. The first part, which is I think is a logical question to ask, which is why is it that we are noticing the improved performance of these factors so much more in the latter part of the sample? And I think the answer lies in the first graph that Ryan showed, which is that if you think about the biggest companies at least in the US back in the 80s or in the 70s, which is the start of our sample, a lot of them were basically manufacturing very heavily based on physical assets types of firms. And I think what that graph shows is that now, if you look today at the largest firms by at least market capitalization, we can clearly see that the majority of their assets are actually intangible assets. When you think about the Amazons or the Googles or the Apples or even the Teslas of the world, the benefit to them is all of these ideas and the organizational capital and investing in their employees. So I think as you're looking at when we are looking at the adjustment, if you're thinking about this from, we are just correcting a measurement error in these variables. If you look at it in the 70s, we were not correcting much. A lot of these companies did not have a lot of intangible assets. So the traditional HML measure was probably as good as HML OBS back in those days, or probably even better if you're looking in the 50s or 60s, which we don't have a part of the sample. But then as you move along to the 2000s and specifically the 2000s and 2010s, that's where these corrections of these measurement errors are actually having a lot of bite. And I think that's kind of the story that we are trying to outline in the paper, that as intangible assets become more and more dominant factors of production in the US and around the world, we should make these adjustments. We suspect that what we are talking about is going to be even more dominant as you move forward, because I don't think we're going to switch back to a manufacturing type of economy. I think we're going to be in a knowledge economy going forward.
Thank you. And then I'll just looking through the questions. I think I will probably go to a final one. So question on inflexibility. So a risk-based explanation of the traditional HML or value factor is the inflexibility of the fixed assets of the firm. So can you share any perspectives for the HML off balance sheet?
So in terms of, I'm gonna take inflexibility and recast it as adjustment costs, which is actually goes right back to the heart of our theoretical foundation. So if you think that HML is due to inflexibility, and there are definitely academic papers that make that point, that's Liu Zhang's 2005 whole thing. HML comes from the irreversibility, which you can cast irreversibility as an infinite downside adjustment cost. And so that's absolutely one potential source theoretically of the value factor. So if you think that it's tough to reverse physical investments, it is only harder to reverse intangible investments. To the extent that you can reverse physical investments, that's things like selling your, the machine or the car that you were using, or, or whatever building you'd purchased for your firm. Selling intangible assets like human capital, well, selling human capital is illegal. Selling brand capital is hard. And so my 2017 paper with Luke Taylor, which was called Intangible Capital and the Investment Q Relation, estimated, estimated coefficients on investment Q regressions, which can be recast as an estimation of these adjustment costs. And we find dramatically higher adjustment costs for intangible assets relative to physical assets, which I think just speaks directly to the adjustment cost motivation in this paper. So I'm going to say more, now I've forgotten the word that was used, more inflexible than physical assets.
May I say a few things also? So I think that I see also questions about whether this would work in the future, risk or mispricing stories. I think it all depends on, at the end of the day, if these are, eventually because of risk or mispricing, right? One would argue that intangible assets are more difficult to measure. So the behavioral, factors can play a role, and it may be a mispricing story. On the other hand, as Ryan also truly observed or stated, that because of the reversibility, it can be a better measure of risk story, right? So if it is the first, right, if it is behavioral story, and especially given the quite interest in these topics over the few years, as traders trade on it, right, we expect this to go down. But if it is more risk side of things, then it may still stay there. So whether this work in the future in terms of risk-adjusted profitability measure, it also depends on whether this is a risk or mispricing based measure. And also to the Mads Nielsen's questions about cash flow, I know Murat mentioned something about this. So one important aspect that I want to stress is the success of our model or the empirical framework is the separating HML into two components. So if you lump them together, somehow it is not doing as good of a job, because I think there is a value of these both off-balance sheet intangibles and also tangible assets, I think playing a significant role on their own. If you combine them together, it somehow goes down. So if you move to a, for example, cash flow to price ratio other than HML, then you are in a way lumping them again together. So I suspect that it's not going to do as a good job to capture, partially because we don't have a good way to decompose cash flow, whether it is coming from the balance sheet or the off-balance sheet intangible investments. So to the extent that we can separate the two and gain from the the flexibility, I think this is going to lead to increased Sharpe ratios. But PE ratios or cash flow to price ratios will be difficult for us to disentangle in that dimension.
thank you very much for those explanations as well. So I think we are through with time that we planned for questions. So thank you for the presentation, Ryan. Thank you for your availability for answering the questions. Thanks to participants also for attending. So all participants will receive the material, obviously. So you will receive the presentation material by email after the session. So thank you very much, and have a good rest of the day. Thank you.
Thank you for having us.
Thank you, Felix.